a deep correction could be on the horizon. Let's discuss with Matt Maley and Miller Tabak, Gina Sanchez of Lido Advisors and Chantico Global. Matt, you say a correction looks obvious. What are you saying that the market is not?
Well, I mean, one of the things I'm going to say when I use the term obvious, I was really just trying to show how there's a huge amount of froth in the marketplace right now, much like we've seen at other important tops of the market that only became obvious in hindsight. I mean, you look back at 2000, we had investors that were, piling, individual investors piling into the markets. We had people who were, we had valuations that were off the charts. We had stocks of companies that had no short-term or even long-term fundamental basis for their moves flying through the roof. And of course, the market eventually rolled back over. And we saw the same thing in 2007, 2008, when you had, this time it was the housing market where people were buying buying houses with no money down or just 5% down, no documentation that they had a job or anything like that. And again, we had a market that was overbought, extremely overbought, and extremely expensive. Now we have a very similar situation where you have the stock market where it's you have the meme stocks which are flying up. Companies with absolutely no, they're not going to change the world. These stocks are going up 2,000% in just a few days. You have the SPACs that have been going crazy here. We have a stock market that's very, very expensive and a market that's overbought. I mean, you look at the QQQ; it's now at almost 70% premium to its 200-week moving average. That's higher than any of the last three before any of the last three corrections. Now, again, I'm not trying to compare this and say, oh my gosh, we're about to hit to one of those crazy, really ugly bear markets that we saw in those last two times. I'm just saying that there's some froth out there that nobody's going to mention until after the fact. And what I think people should do is raise a little bit of cash. It doesn't mean sell everything. Go to 50% cash or even 20% cash. But if you raise a little bit of cash, you'll be able to buy the stock if it corrects. But more importantly, you won't be selling when the market's down 15 or 20%, when everybody else is selling at the exact wrong time. You'll be the one keeping your head, holding on to your winnings, and be able to take advantage of the market when it goes back up.
Gina, a lot to unpack there. Do you agree or disagree with Matt? Are we due for a pullback?
Well, look, I think Matt is making some really important points, particularly about the froth that is happening. And I think that part of what's feeding that excess froth and money that's finding its way into Robinhood stocks, finding its way into SPACs, finding its way into crypto, is a lot of the excess money, the fiscal stimulus, the monetary stimulus, and just the amount of liquidity that's generally sloshing in the economy. And to Matt's point, when you start to get those excessive moves, there is certainly the potential. What I look for is a catalyst. And I see two possible catalysts, Seema, that could actually bring forward some volatility at the least and a correction at the worst. The first catalyst I see is just the fact that we have priced in very strong expectations. We're going to hit huge GDP growth this year. Next year, we're going to have lower GDP growth. Will it still be strong? Yes, but it will be less than now. We priced in enormous earnings growth because we had very weak comps. Now we're going to go into stronger and stronger comps. And we're going to settle and see where the economy is going to be after the pandemic, after the Delta variant, and whatever variant comes after this. And so there is a lot of potential for disappointment now because we've actually hit all those numbers handily, I might add. But at this point, all the comps get harder. So that inflection point tends to be fraught with volatility. I think the second and more important catalyst I'm looking for is when the liquidity starts to get dialed and sucked out of the market. When that happens, I think that's when you could have a real potential correction. That's going to be based on the Fed. It's going to be based on what happens with lending programs. It's going to be based on all of this excess liquidity that has been available that either may not be available or when you get to the other side where you have to start paying that back.